morning, people. So in today's session, we'll be looking at September 2024 ka advanced accounting paper. Alright. So without further delay, let's get started. Now the case-based question of this particular paper, I've already done a video on that. It's already available on YouTube, so you can refer to that. So they had added some good case-based MCQ in this particular paper. So do watch that particular YouTube video. We have solved all the MCQs. Okay. So in this particular session, I'll be taking up all the descriptive, because MCQs, everything I've done it there itself. So descriptive paper we will be going through in this particular session. 2 or 3 questions are new. I would say probably 2 are new. 1 or 2 could be another adjustment. The rest everything is pretty much the straightforward. So again, like as I've been telling, so we will be doing all the new questions. If the concepts are same or if it's a similar question, we'll not be doing that. We'll only be covering the new types of question that has come in this particular paper. Okay. Now question number 1, though repetitive, maybe quickly we'll just review this. In the following case, record journal entry for amortization in the books of Huge Limited for the year ended 31st March 2024 as per AS 26. AS 26 talks about intangible assets. So amortization of intangible asset question this is. The company had acquired a patent rights. So patent is an intangible asset. They had purchased a patent for how much? 340 lakhs. Which year? 1st April 2022. Now we are talking about 31st March 2024. So first year is what, sir? 1st April 2022 to 31st March 2023. Are we charging amortization for this year? No. So our current year is what? 1st April 2023 to 31st March 2024. So we are talking about second year ka amortization in this particular question. Yes? Okay. They purchased the patent on that day and the useful life of the product is 4 years. The patent useful life is 4 years. Amortization was decided based on the future cash flow. So in the ratio of future cash flows, they want to amortize. So in this particular ratio, you need to amortize. It's pretty straightforward. Adding all this cash flow, you will get total to be how much? 1190. What will be amortization for first year? First year amortization will be 340 lakhs into 140 divided by 1190. How much is this now? 40. Do we need this number? No. They asked amortization for which year? Year 1 or year 2? Year 2, because 31st March 2024 is our current year. So second year you need to calculate amortization. So what is the journal entry for amortization? Amortization account debit to patent account. So entry the calculation will be 340 lakhs into what? 350 divided by 1190. Basically in this cash flow ratio you need to amortize. That's all. Okay. So amortization will be how much? For this year the amortization, for second year the amortization will be 100 lakh. And this amortization is an expense which will be transferred off to P&L account. Very straightforward question. Yes or no? Correct? That's all they had to ask. But be careful. Don't put it for first year. They asked the amortization only for the second year. Just be aware of that particular concept in this particular question. Okay? Yes. Then this one again is a repetitive question. We have a similar question. But anyways, since we have done first part of the question, we'll finish off this as well. The company had developed a know-how. Know-how is an intangible asset. Okay? Know-how means it's a obviously like this. I had given an example of Pepsi and all. Now, can every person produce Pepsi, or there is a specific formula? To produce a drink called a Pepsi, you have a specific formula. That formula and all we call it as what? Know-how. So that is also an intangible asset itself. The company had developed a know-how by incurring expenditure of 80 lakhs. The know-how has been used by the company since 1st April 2018. Life is 8 years. From the years of commencement of its use. Okay. Alright. The company has not amortized the asset till 31st March 2014. So, sir, when is this intangible asset available for use? 1st April 2018. We are currently in which year? 31st March 2024. Count 2019, 20, 21, 22, 23, 24. 6 years has passed and the company has not even charged the amortization. Have you not done a similar question? Okay. That means this is treatment right or incorrect? Incorrect, because 6 years over and they have not charged the amortization. I have written here 5 plus 1. Can someone tell me why 5 plus 1 I have written? Current year, anyway, current year ka amortization aram se you can charge, no big deal. But 5 years ka amortization, is it relating to current year or it's a prior period item? Prior period item, and we've studied AS5. Prior period item means they are those income and expenditure which arise in the current year due to some errors or omission in the previous financial statements. In the last 5 years, you have not even charged amortization. That means, obviously, this is what, sir? Prior period item. Prior period item ka amortization, you need to show it separately. Okay. So the calculation will be, what is the entry? What is the entry for amortization, by the way? Amortization account debit to intangible asset. Here is know-how. right? Can you just put amortization for 6 years? No. 5 years amortization is a prior period item which needs to be shown in P&L, current year ka P&L separately. Hence you will write prior period item account debit. How much? 80 lakh is the intangible asset ka value. How much is the useful life? 8 years. Have they given the cash flow? No. Sir, if they give the cash flow, amortize in cash flow ratio. Otherwise use straight line method. So 80 lakh divided by 8 if you do, what are you going to get? 10 lakhs. That is amortization for 1 year. How many years they have not charged depreciation? 6 years. What is prior period item ka years? 5. So calculate 80 divided by 8 into 5 if you do, 50 lakh rupees is the amortization relating to the last 5 years, which becomes your prior period item. Okay. Then current year, anyway we are in the current year only. So current year amortization, is it a prior period item? No. So current year amortization, you can charge it as normally. Okay. So amortization account debit, 80 lakh divided by 8 into 1. That is how much is the amortization for current year? 10 lakh. To what? Intangible asset 60 lakh. This both prior period item and amortization will be transferred to P&L. Okay, amortization will come under depreciation amortization category. Prior period item has to be shown in P&L separately as per the requirements of AS5. So both will be transferred, but you need to segregate. Both, though entire 60 is amortization only, you need to show the prior period item separately. We have done a similar question, is available in our class notes and study material as well. Any doubt in this? Pretty straightforward. Online also so far there. Everyone good? Can I move forward? Okay. Next is this. Okay, let's go for this. Pandora Limited has given the following details with respect to employee benefit pension plan. Okay. The fair value of plan assets on 1st April 2023. That means this is your opening balance of fair value of plan assets. How much is that? 5 lakh. Benefits paid on 30th November 2023 is 63,000. Inward contribution received on 30th September is 1,42,000. Fair value of plan assets and on 31st March 2024, meaning the closing balance is 7,50,000. Okay. Similar question, but one point is new over here, so we will see. In fact, you need to find out, the requirement of the question is you need to find out expected return and actual return. Is this a new question to us or similar? Similar. So how do you get this actual return? In fact, I told you the ledger also, right? Okay, if you prepare plan asset ka ledger balance, what do? Opening balance of assets, where it will come? On the debit side. Then benefits paid. Benefits paid means what, sir? You are paying the amount to employees. Now, will you pay this benefit using cash balance or you will sell the assets? Company will sell the plan assets, get the money, and that money they will pay off to the employees. That means to pay the benefits, what should the company do? They should sell plan assets worth how much? 63,000. What is the journal entry for plan assets sold? Bank account debit to plan assets. So you will post it as Buyback 63,000. Okay. Then inward contribution 1,42,000 you have received. Inward contribution received means we have purchased additional plan assets worth how much? 1,42,000. Plan asset is an investment. What is the journal entry for investment purchased? Investment to bank or plan assets account debit to bank account. How much is that? 1,42,000. Any problem? No. Then fair value of plan assets at year ending. So closing balance of assets, where it will come? On the credit side, you'll write buy balance carried down 750. All these components you have, you need to get actual return as a balancing figure. Okay, I had explained to you in class through ledger, but I had told for examination use formula because our ICA material uses formula. What is that formula? Now you need to get this as balancing figure. So these two you need to add, these two you need to minus. So what is your formula now? Take fair value of plan assets at year end. Then to that you add what, sir? Benefits paid. Deduct the contribution received. Deduct fair value of plan assets at year beginning. You will get the actual return on plan asset, which is 1,71,000. Any problem? No. Okay. This is one part of the question. Actual return. They also asked expected return. So let's see. On 1st April 2023, the company has made the following estimates based on market studies and prevailing prices. Interest, dividend income after tax is 10.5, realized gain 2, fund administrative expense -2. Final we need number is this. Expected rate of annual return is how much, sir? 10.5%. That means on our plan assets we will get some return, no? How much is the return? 10.5%. What is one change between this problem and all the problem we have done in the class versus all the problem available in study material is, I have told you study material in all their problems assumes the compounding to happen on a half yearly basis, if you remember. But here they told in the question compounding is happening on what basis? Annual basis. So you don't have to use half yearly compounding. If you have to do half yearly compounding for 12%, 10.5% is the interest rate for 12 months. For 6 months, if I told you the short rate is 5%, shortcut. Okay, so we have to use all that here or not required? Not required, because in this problem, compounding is not happening on a half yearly basis. They told clearly in the question that it is happening on a annual basis. That is a distinction between the problems we have done so far and this particular problem. Only one adjustment, compounding adjustments different. Can we do it? Alright, now how do you get this expected return? Simple. Sir, how much money, sir, return means you will get it on what? Plan assets. How much was the opening balance of plan assets? 5 lakh, okay? So now we can present this in multiple ways. Here, one more catch in this particular problem is, in normally all the problems we solve, this benefits paid date and contribution date will be same. It will be same usually, okay, after 6 months. But here, check, benefit is paid on now, 30th November, but contribution is received on 30th September. These two are same or different? These two are different. That way also, this question is slightly different from the ones we have solved. Okay, and keep this in mind that it is not half yearly compounding, it's your normal annual compounding. Annual compounding means 10.5% is a rate for 12 months. Okay, like that. Now check, how much is the value of plan assets? 5 lakh. Okay, now stop there. This 5 lakh was there from the beginning till the year ending. This 5 lakh was there from the beginning till year ending. So how much percentage return you will get? 10.5%. For how many months? 12 months. Comfortable? So that's what I've written over here. On return on 5 lakh, you will get it for like the rate of 10.5% for 12 months. So calculate that. How much is it? 50 to 500. Any problem? Any problem, anybody? No. Now, benefits paid out on 30th November, 63,000. Now you paid how much benefit? 63,000. Or maybe I'll explain like this. This may be a little easier for you. Study material has presented like this, but I think this is a bit easier way of understanding this question. Now, 5 lakh rupees of plan assets you had at year beginning. Out of this 5 lakh, how much investment you sold to pay the benefits? 63,000. And when did you sell this plan asset, sir? 30th November. Now, just touch your heart and tell, was 5 lakh available for whole year or only for 8 months? 8 months. Why? Sir, out of this 5 lakh, 63,000 was there in the company only from what? April, May, June, July, August, September, October, November. Because on 30th November, you wanted to pay the plan benefits. That's the reason you sold off investment. So how many months have you invested? 8 months. Yes, sir. How many months have you invested? 8 months. Correct? Okay. That means we will split up. Out of this 5 lakh, 63,000 you have invested only for how many months? 8 months. Comfortable? Why 63,000? Because you need how much money to pay the benefit? 63,000. Easy. Out of 5 lakh, 63,000 you have invested only for 8 months. So calculate 8 months interest for me. 63,000 into 10.5% into 8 by 12. How much is that? 4410. Any problem? No. Now out of this 5 lakh, 63,000 you invested only for 8 months. What about balance 473? Did you touch that? No. It was there from the beginning till the year ending. I mean, this 437 was available from April to March. How many months? 12 months. So calculate full year interest for me here. 4,37,000 into 10.5% into 12 by 12 if you do, you will get 45,885. That means on totally this 5 lakh, how much investment have you earned? These two addition if you do, you will get 50,295. Understood everybody? Any problem anybody? No. This is one way of presenting. What study material presents is they are presented on a minus approach basis. First check, they will calculate 10.5% on 5 lakh for how many months? 12 months. But was this entire 5 lakh invested for 12 months? No. Out of this 5 lakh, 63,000 was invested only for how many months? 8 months. But we calculated interest for how many months? 12 months. That means how many months extra interest have you calculated? You have calculated interest on 5 lakh for 12 months. Out of this 5 lakh, 63,000 was invested only for 8. So how many months extra interest have you calculated? 4 months. That you subtract. That's another way of presentation. Calculate now. 63,000 into 10.5% into 4 by 12. How much is that? 2205. These two ka minus you do. These two ka minus you do. 50,500 minus 2255. How much is that? 50,295. One and the same. I think this is easier for understanding wise. Okay, but this is more like I say a presentation. Choice is yours. The way you want to present it is yours. Hope you understood this also. Simple. Why are they reducing 4 months interest here? Because on this 5 lakh, we have calculated the interest for 12 months. But entire 5 lakh, was it invested for 12 months? No. Out of this 5 lakh, 63,000 was invested only for 8 months. But we calculated interest for 12 months. How much extra interest we calculated? 4 months ka. That 4 months ka extra interest we have to reduce. That's all. Okay, G. Okay, next. Inward contribution you received on which date? 30th September. Inward investment means nothing but additional investment purchased. When did you purchase this investment? 30th September. And when is the year ending? 31st March 2024. That means this 1,42,000, how many months can you invest? October, November, December, January, February, March. That means on this 1,42,000, you will get interest for how many months? 6 months. So calculate that. 1,42,000 into 10.5% for 6 months will give you 7,455. Adding all this, you will get the expected return. Done, people? That way, this question, as I would say, is good. Two bases, two new pointers from this particular question. One is that. One is what? One, the compounding is not happening on a half yearly basis like we have done majority of our problems. Here it's happening on an annual basis. That is one. Second observation here is usually in all our problems, benefit paid and contribution paid was same. It used to happen on the same date. Is it happening on the same date? No. So hence what you have to do over here, you'll have to accordingly prorate. Okay, that's takeaway of this particular question. If you need a minute, I'll wait, or if you have any doubt, you can ask, else I'll move forward to the next question. Online also, okay, G? That will be a little difficult because here 3 months to calculate again compounding return will be too much. If they ask different dates, usually they'll give annual compounding only. They'll not give half yearly compounding. So they'll frame like this only. Otherwise, if they want to give half yearly compounding, they'll make contribution and benefits paid date to be same, like all our problems. Like if different dates comes means they will frame like this only. Move along. Okay, so this is the repetitive question on AS22. Same is available on our class notes, so that's okay. Next to this one is same. This question seems to be quite popular, people. Okay, this land. Do you remember this adjusted purchases and all? Okay, it's come in many RTPs, MTPs. Illustrations. Correct. Study material. A lot of many RTPs, MTPs. This is repeated. Okay. One good thing or one extra adjustment they added in this particular problem is maybe that alone I'll discuss. On 31st March, company issued some bonus shares. This adjustment was not there in the previous problem. This got adjusted. That impact, only one impact will be there, that I'll quickly discuss. Company issued bonus shares to the shareholders on what basis? 1:2 basis. Meaning if you have 2 shares, you will get 1 as bonus. How much is the equity share capital? 200. So if you have 2, you will get 1. If you have 200 means how much? The bonus will be 200 into 1/2, which will be 100. Correct, 100. All these numbers are in thousands. So 1 lakh or 100,000 is the bonus shares you will issue. Now, what is the first priority for bonus issue? First priority for bonus issue is CRR. If CRR is missing, securities premium. If securities premium is also missing or insufficient means, then you will take up free reserve, general reserve and P&L. Here, do we have security? Do we have CRR? No, CRR is not there. Do we have SP? Yes. How much is that? 27. That means out of this 100 lakh, okay, for bonus issue, first 27 you will use from what? Securities premium. Balance you will use it from general reserve or P&L. How much is that? 100 minus 27 is what? 73. 73 you will use from general reserve. Done. Now tell me, due to this bonus issue, what will happen? What is the entry for bonus issue? Security premium account debit, general reserve account debit to bonus to shareholders account. I think we have passed entry. In our buyback and all, we have passed bonus entry. Bonus to shareholders account. How much is that? 27, 73 and 100. Second journal entry is bonus to shareholders account debit. Bonus to shareholders account debit 100 to equity share capital 100. It means finally if I have to tell the impact of this, what is the impact this bonus will cause on your balance sheet? Your equity share capital will increase by 100. Your security premium will reduce by 27. Your general reserve will reduce by 77. This is the impact you need to give in balance sheet. Journal entry not required. They have not asked. They only asked you. This impact you need to give in balance sheet. That's what I've called out over here also. Done, people? That is one adjustment. Extra adjustment. They asked it over here. Any problem? No. The one more thing is that the company declared a dividend of 10% on 5th April. Sir, our current year is ending on 31st March. But bonus is declared on 5th April. That means bonus is declared in the current year or next year? Next year. And we have already studied. As per Companies Act, dividend should be accounted in the day it is declared. When was it declared? 5th April. That means it will be accounted in which date? 5th April. Current year, you only give a disclosure. This we have done enough. Every question where this was there. That is not a new one. Check this. It also transferred profit at 10% to general reserve. 10% of profit is transferred to general reserve. That means you are transferring from P&L to general reserve. Because of this, P&L balance will reduce, general reserve balance will increase. Easy. The question is which profit? Because if you just check the question, you have some P&L already existing. P&L already existing is what, sir? Accumulated profit or opening balance of profit. And in this particular problem, you need to prepare balance sheet also, you need to prepare P&L also. When you prepare P&L, you will get what? Current year profit. When you prepare P&L, you will get current year profit. Opening balance of profit is already available 48. 10% you will calculate on what? On opening balance, current year or total. That is a confusion. Are you getting it? That's the reason I'm discussing this particular pointer. When they say transfer 10% of profit to general reserve, it is always 10% of current year profit is transferred to general reserve and not opening balance. When you prepare P&L, you will get current year profit. No, of that calculate 10% and transfer it to general reserve. That's all is a highlight of this particular question. Any problem, sir? Okay. The rest everything is same question, no point in discussing, okay, at this point of time. Okay. Excuse me. All right, cash flow statement, one question they gave. Concept is pretty much clear, same only, but anyways, they've asked the question slightly differently, so I'll quickly take you through this particular question as well. On the basis of the following data, prepare a cash flow statement as per AS3 for the year ended 31st March 2024. Total sales for the year was 380 lakh, of which cash sales was 262 lakhs. Okay, so the moment they give you cash sale, just quickly read the data. They gave receipt from credit customers. Credit customers means debtors. Then they gave here suppliers and other consumables were paid 19 lakh. Employees were paid 20 lakh. By looking at this data, what is coming to your mind? No. Sir, in AS3, to prepare operating cash flow, we have two methods, direct method and indirect method. Which one will you use over here? If cash paid to cash sales, cash received from debtors, cash paid to creditor, cash paid to employees, etc., etc., if it is directly given to you in the question, then it becomes a direct method. If these information, if it is not given, but if they give you P&L in the question, then you will have to use indirect method. Because here in this question, they have not mentioned the method. But at the same time, they have not given P&L also. But operating cash flow is directly given. So that means which method we have to use over here? Direct method. Though they have not mentioned the method, you should be able to conclude that. Okay, na sir? Okay, direct method is pretty straightforward. No, take the data and dump it into your cash flow statement ka format. First, total sales is 380. Cash sale is how much? 262. Cash sale will come under which activity? Under operating activity as what? Inflow. Yes, maybe we'll tick off this. Check, this is your operating cash flow. Cash sale is 262 lakhs. Okay, sir? Alright, like this one by one we'll tick off. Receipts from credit customers. Credit customers means our debtors. How much is the cash received from debtors? 134. Where will cash received from debtors come under? Operating activity as an inflow, meaning as a positive number. Okay? Okay, next. Total purchases was 220. Of that, 80% was credit purchase. So if 80% is credit purchase means 20 will be cash purchase. So calculate 220 ka 20%, how much is that? 44 lakh. Cash purchase will come where? Under operating activity as a minus. Check, have they written minus 44? Yes, cash purchases. Alright. Next, what have they given next? Opening balance of creditors and closing balance of creditors they are given. So opening balance of creditors you know, closing balance of creditors you know, credit purchase you know. Can't you find out cash paid to creditors? Put up a working note here. I've put up parallelly over here. Opening balance of creditors how much? 84 lakh. Then closing balance of creditor is 92 lakhs. Then how much was credit purchase they told? Total purchase was 220. In that 80% was credit. So calculate 220 ka 80% is how much? 176. What's the journal entry for credit purchase? Purchase account debit to creditors. So in your creditors account you'll write by purchase is 176 lakh. Ledger, these two are total, if you do it is 260. Ledger is not matching, so you will get obviously cash paid to creditor as a balancing figure, which is how much? 168 lakh. So this 168 lakh will come where? under operating activity as a negative number. Check, have they shown 168 negative? Yes, that's what they've done. It's not necessary you have to put up a ledger. You can also present like this. Plus minus format may also, if you're comfortable, you can present. That presentation is your choice. Move along. Okay. Suppliers of other consumables and service were paid 19 lakh in cash. Okay. So obviously, so you will not purchase just raw materials. No, you may purchase other things also. So some other consumables we have purchased to manufacture the goods or to sell the goods, we don't know. And how much have you paid for that? 19 lakhs. So where will this come under? Under operating activity as a negative. So some cash paid to suppliers and consumables, 19 lakhs. Alright, next is what, sir? Employees were paid 20 lakhs in cash. So cash paid to employees will come under which activity? Operating activity. All these are necessary to run our operations. Yes. So cash paid to employees also in operating activity as a negative. Next is what? Fully paid up preference shares of face value 32 lakhs were redeemed. So redemption of preference shares, what activity? Issuing preference shares is a way of raising finance. So redeeming preference shares is also what? Finance repaid. So it will come as what activity? Financing activity as a minus. How much did you redeem it at? 32 lakh. So where it will come? Under financing activity as a minus. This is your financing activity. Redemption of preference shares 32 minus. Okay, next. Issued equity shares of face value 20 lakh at a premium of 20%. So what is the issue price totally? 20 lakh plus 20% if you do, it will be 24 lakh. Issue of equity shares is what activity, sir? It's a way of raising finance. So this will come under which activity? Under financing activity as an inflow. So check, 24 lakh have they shown? Yes. Proceeds from issue of shares, 24 lakh, positive number. Okay, next. Debentures of 20 lakh at a premium of 20% were redeemed by issuing equity shares in lieu of their claims. So debentures you have redeemed. How much you need to pay? 20 lakh plus 10%. You need to pay 22 lakh. And how did you pay this 22 lakh? Did you pay it in cash or you paid it in shares? You paid this in equity shares. So debenture got redeemed, but what came in or how it got redeemed? Through issue of equity shares. Tell me, in this particular transaction, is there any cash coming in or cash going out? Or no impact on cash? No impact. If there is no cash flow, means will this component come in cash flow statement? No, because cash flow statement only captures cash and cash equivalents coming in, cash and cash equivalents going out. In this transaction, there is no impact on cash. Hence, this is ignored for CFS, as in cash flow statement purpose. This is ignored. Okay. 26 lakh was paid by the way of income tax. If they don't give the nature of, then income tax we always show it under which activity? Operating activity as a minus. So where is that? Income tax paid 26 minus. Next is what, sir? A new machinery costing 20 lakh was purchased in part exchange of old machinery. So a barter system. Old asset you are giving and buying off a new asset. What is new asset ka cost? 20 lakh. What is the book value of old asset? 13 lakh. But what are they saying? But the vendor agreed to take over old machinery at a higher value of 15 lakhs. Sir, what is the value of new asset? 20 lakhs. But old asset was exchanged at what price? 15 lakh. That means how much extra cash you need to pay to the vendor? 5 lakh. So 5 lakh cash outflow, where it will be shown. This is cash outflow relating to purchase of asset. Purchase of asset is what activity? Investing activity. So 5 lakh will come under investing activity as a minus. Check, have they shown that? Investing activity 5 lakh minus. Literally no calculations over here. Just take the data and dump it into format. A very straightforward question. Dividend of 15 lakhs including dividend distribution tax of 2.7. This DDT, it's actually abolished. I don't know why they asked it. Okay, but anyways, no problem. Sir, I told you, sir, tax could be either operating or investing or financing. Alright, if they don't give the nature of tax, we always put it under operating activity. Like here, dividend distribution tax will come on what? Dividends paid. Dividend paid is what activity for the company? Financing activity. So dividend distribution tax is also what activity? Financing activity. Like when you sell an asset, sale of asset is what activity? Investing activity. When you sell the asset, if you pay any long-term capital gain or short-term capital gain, that is what activity? Investing activity. So if they give the nature, we will put it accordingly. If they don't give the nature of tax, we will show the tax under operating activity. But here we know the nature. No, this is on what? Dividend. This 15 lakh of dividend includes what? Dividend distribution tax. How much is that? 2.7. Me saying or question saying that? Question saying. Doesn't matter. Dividend and dividend distribution tax, both are what activity? Financing activity. So either you can show how much In 15 lakh, how much is the DDT, dividend distribution tax? 2.7. That means how much is dividend? 12.3. You can show these two separately, or you can show 15 lakh itself directly as financing activity. My preference is showing both separately. ICA has shown one. Okay, under financing activity, they just showed dividend paid 15 lakh. My preference is better to show the components separately. But anyway, this is an outdated concept. Ideally, they should not have asked this, because dividend distribution tax anyway is now abolished. Okay, no problem. Debenture interest of 3 lakh rupees was paid. Debenture interest paid what activity, sir? Financing activity. So 3 lakh under financing activity they have shown. Okay, next. 8 lakh rent was received from property held as investment. You are holding some property, some land and building as investment. On that you have received a rent. So what sort of activity is this? Investing activity, 8 lakh as an inflow. Investing activity, 8 lakh inflow. Okay, next what? 0.5 lakh rupees interest was earned. Earned means received. Income, okay, it's the income side. On advance payment to supplier of goods. So supplier of goods is associated with investing, financing activity or operating activity. Supplier and all, customer, supplier and all is relating to operating activity. So any interest received from them also will be coming under which activity? Operating activity itself as a positive number, 0.5 interest on advance payment to suppliers. Yes, our people. Anything else is given? Cash and cash equivalent on 1st April 2023. This is opening cash and cash equivalent. So that is 2 lakhs. Okay. Then if you add this, you will get the closing cash. Rest everything what we have not ticked is simply the total part of it. Okay. So this was a pretty straightforward question for 7 marks. Nothing to be done. In 5 minutes, 5-10 minutes, you could have finished this question. Okay. Because the next 1 or 2 questions, they made it lengthy. So that's the reason these sort of questions, they kept it very straightforward. That way, paper will always compensate. I don't know, many students found September 2024 paper quite tricky. I do understand, case was good. Case-based question, 30 marks, they asked some good questions. Alright, but this one was pretty straightforward. Other than consolidation, even consolidation was also okay. Alright, but anyways, in my view, it was still an above average paper, you could say. Alright, so moving along now. So this one is a repetitive question. Same, buyback wala question. This is maximum permissible buyback. 3 limits you need to test and accordingly give a conclusion. That is pretty much same. Okay. Then this one and one more question if you do. This particular session is over. Okay. AS 14. This was a good question because the reason is when we read the paper, there was a slight confusion whether this is an internal reconstruction plus AS 14 wala question or only AS 14 wala question. The reason why that confusion came into mind is one, they gave, check here, reserves and surpluses negative. Come to note number 2. Balance in P&L is 7350 negative. So that means P&L has a debit balance. And in one of the adjustments, they told bank agreed to waive off the loan. Usually the waive off and all will happen in which case? Internal reconstruction. But they nowhere they mentioned in the question internal reconstruction. Okay, so there was some confusion whether ICA is wanting the students to interpret this as an internal reconstruction and amalgamation or only amalgamation. Apparently, they have interpreted only to be amalgamation. So use internal reconstruction only if the question says internal reconstruction, otherwise don't apply internal reconstruction. A pretty straightforward amalgamation question in fact. Okay, but still I will run through this question. We'll go through this whole question, then we will see what to be done. The following is the summarized balance sheet of Well Limited and Nice Limited as on 31st March 2024. All the numbers are in thousands. They've given the usual balance sheet. That's okay, nothing much fancy. Fine, let's go to notes to accounts. So share capital, we have equity share capital as well as preference share capital. One company ka has 9% preference share capital of 100 each. Another one has 10% preference share capital of 100 each. Okay, P&L account of Well Limited has negative balance, fine. Same goes for debenture. One company has 9% debentures of 100 each, another one has 10% debentures of 100 each. Loan from bank is okay. Details of trade receivables and trade payable. Here they gave trade receivables, no? So they have given the breakup of it because trade receivables means what? Debtors and bill receivable put together. That's what they've given the breakup over here. Debtors is this much, Bill receivable is this much. Put together, it has become trade receivable. Trade payable means creditors and bills payable put together. So they've given the breakup. Maybe there's some mutual owings. That's the reason they've given the breakup. We'll see. Okay, on 31st March 2024, this balance sheet also was on which date? 31st March 2024. Okay, on the date of balance sheet itself, Nice Limited absorbs the business of Well Limited. So Nice is the purchasing company, Well is the selling company. Okay, on the following terms. For every 5 equity shares held by equity shareholders of Well Limited, they will receive 3 equity shares of Nice Limited issued at a premium of 20 per share. So is this PC? Yes, because to equity shareholders of the selling company, purchasing company is giving new equity shares, straightforward or in some ratio? In some ratio, and these new shares are issued at par or premium? Premium. That means if they ask you to pass journal entries in the books of purchasing company, will only equity share capital come or also securities premium? Securities premium. Once we will run through the adjustments, full adjustments, then we will dive further. 10% debenture holders of Well Limited, that is selling company, were to be allotted such 9% debentures in Nice as would bring the same amount of interest. So to the debenture holders of selling company, we are giving debentures of the new company or purchasing company only. But is value of debenture given or missing? Missing. You have to give debentures in such a way that interest amount should be same. Go back. How much is the debentures of the selling company? 900. What percent debentures we have? 10%. So 900 ka 10% is how much? 90. So currently the debenture holders in selling company are getting an interest of 90. All these numbers are in thousands, correct? After the purchasing company is taken over, should this interest amount change or it should be same? It should be same. That's what they are asking. Again, we will see. That's the meaning of this particular sentence. Okay. I'll again solve. First, I'll read off a whole adjustment. 10% preference shareholders of Well Limited are to be paid at 10% discount. How? By the issue of 9% preference shares at par of Nice Limited. So is this PC? Yes. Because PC means what you give it to the purchasing company gives to the owners of selling company. And who are the owners of selling company? Equity shareholders and preference shareholders. So the first one, is it PC? Yes. Third adjustment, is it relating to PC? Yes. To debenture holders, whatever you pay, is it PC or not a PC? It's not a PC. Bank agreed to waive off 2,70,000 of Well Limited. So we are not, it's not an internal reconstruction. So if bank is agreed to waive off means sacrifice. How much they are agreed to sacrifice? 2,70,000. That means does selling company have bank loan? Yes. How much bank loan they have? 4,525. Can the new company take over bank loan at 4,525 or bank has sacrificed something? Bank has sacrificed. That means what is the balance of a loan? 4,525 minus 270 if you do 4,255. New company will take over this liability only to the extent of 4,255. That's what they are trying to say. Easy. Alright. Great. Next. Expense of liquidation of Well Limited are to be reimbursed by Nice to the extent of 55,000. This is your amalgamation expense. If it is purchase method, what is the journal entry? So assets are and all are revalued, sir. See, inventory taken over at 10% more than book value and all they have given. Even if one asset is revalued, it is merger method or purchase method? Purchase method. What is the journal entry for amalgamation expense under purchase method? That depends. If it is profit, the journal entry will be capital reserve to bank. If it is loss, goodwill to bank. Here I know that it is a loss, so I have written goodwill to bank. Okay, fine, fair. You will anyway get to know loss or profit. Either you can prepare a working note for that or you can prepare journal entry number 2. In journal entry number 2, either you will get goodwill or capital reserve as a balancing figure. Accordingly, you can pass the entry. Okay, great. Inventory of Well Limited, that is selling company, are taken over at 10% more than their book value. What is the inventory of this selling company? 870. Is it taken over at 870? No, it's taken over at 10% more. So the value will be 957. Correct? Debtors of Nice Limited include 2,15,000 receivable from Well Limited. So for one company, it's a debtor means for another company, it will be a creditor. This only we call it as mutual owings. What are we to do? In the books of the purchasing company, you need to cancel by passing the journal entry. Creditors account debit to debtors account. Okay. Property, plant and equipment are revalued at 20% above their book value. Okay. So that means come back. What is the property, plant and equipment of selling company? 16,380. Is it taken over at 16,380 or 20% more? 20% more. And you'll get how much? 19,656. So all these are basically assets at which, the agreed value of assets taken over. That's it. The remaining assets and liability of selling company well limited are taken over at book value. Even if the sentence is not mentioned, we will still take over other assets and liability at book value itself. Fine, that's it. Now tell me, sir, any problem in this question? Isn't this pretty straightforward? Except maybe one adjustment with respect to debentures. Requirement, if you just check, you need to pass the journal entries. Then they ask the balance sheet. Balance sheet to waste only, nothing, no dumb in this question at all. So can we first do some working note? One working note we'll put it for PC. Then one working note we will put for debenture, because they're talking something about interest to same interest and all. So can we calculate PC? So let's go back and read the first pointer again. For every 5 shares held by equity shareholders of Well Limited, selling company, they will receive 3 shares of Nice Limited. For 5 shares, if the selling company shareholders, if they're holding 5 shares, how many new shares will they get? 3. So arrangement is like this. If they have 5 shares in the old company, they will get 3 shares of new company. Alright? Now come back to balance sheet. Do we have only 5 shares in selling company? This is Well Limited. What is the equity share capital? 12,500. How much face value of each share is? 100. So if you do 12,500 divided by 100, how much are you going to get? 125. Again, all these numbers are in thousands. So it's okay. We present all the numbers in thousands only. Okay. So if you have 5, you will get 3. If you have 125 means how much? If you prorate, how much you're going to get? Number of equity shares will be 75. It is not 75, it is actually 75 thousands. But anyway, all the numbers are in thousands only. I've written presentation. Here only I've written thousands. Done now. What is this? Value of equity shares or number of equity shares? Number. For PC, we need number or value? Value. Each preference shares in the new company is issued at how much premium? 20 rupees. Correct? No? And even this company, both the company ka, selling company and purchasing company ka equity share ka face value is how much? 100 only. So is it issued at 100 or at 20 rupees premium? So what is the issue price? 120. 75,000 is the number of shares, and into 120 if you do, you will get value of new equity shares given, which is 9,000. In this, if you want, you can give a breakup also. In this 775, 100 rupees is towards face value. That means when you have to pass the journal entry, you will credit equity share capital to the extent of 75 into 100, 7,500. Balance will go off to securities premium, 75 into 20, which is 1,500. This will be helpful for our journal entries. Okay, sir. Okay, this is first part of PC which we did. I'll give you a minute, just see if you have any doubt. Alright, moving along. 10% preference shareholders of Well Limited are to be paid at 10% discount. Come back to the question, what is the preference share capital of selling company? 1,800. Is this taken over at 1,800 itself or 10% lesser value? 10% discount is what they are saying, meaning old preference shares you're not taking over and paying at same value, you're taking over at 10% lesser value. So 1,800 minus 10%, you know, how much is that? 1620. And how are you paying this 1620? You are paying this by new 9% preference shares issued at what? Par value. Old component is taken over at a lesser value, and new preference shares you are issuing to that extent at par. You will give new preference shares to the extent of 1620, and this new preference shares are issued at par value only. Any problem? Now this you gave it to equity shareholders, this you gave it to preference shareholders. So you got your owners ka component. So adding these two only you will get what? PC. So add this, you will get 10,620 as purchase consideration. Any problem? No. Can we move along to the next question? Next adjustment. Online also okay, sir? Okay. Moving along. Look at this debenture adjustment. 10% debenture holders of Well Limited, as in selling company, were to be allotted such 9% debentures in Nice Limited as would bring the same amount of interest. Okay, so let's calculate. You can present it in multiple way. I think this is easier to understand. Now, how do you calculate the interest amount of debentures? Take the face value of debenture, multiply by the interest rate. Then you will get the interest amount. Now, currently, now they are saying what, sir? Whatever debenture holders used to get interest in selling company, even after amalgamation, they should get different interest or same interest? Same interest. Check. How much is the debentures of the selling company? This is a well limited as a selling company. What is selling company ka debenture? 900. Currently, what percentage debenture selling company are having? 10%. So what is the interest? 900 ka 10%, which is how much? 90. So should this interest of 90 change or it should be same? That means interest amount you know, which is how much? 90. Correct? But the selling company has 10% debentures. But as a purchasing company giving 10% debentures, check. What did they say? To be allotted such a 9% debentures of a nice limited. That means the new company is not giving 10% debentures, they are giving 9% debentures. That means you got the interest rate. Interest amount is 90. Interest rate is, new debentures ka interest rate is 9%. Can't you calculate the face value of debenture? How do you calculate this? Even in FM also we used to do this, no? Interest amount divided by interest rate. So face value of the debenture is given by 90 divided by 9%. If you do, you'll get how much, sir? Thousands. All these numbers are anyway in thousands. Done. So basically, the debenture holders of selling company are not taken over at 900. They are taking over at 1000. That's what you could say. Because you are giving new debentures worth how much? 1000. Done, people? Any problem? That's what I have presented over here. 10% debentures of selling company is 900. And these are 10% debentures. So the interest will be 90. So what will be the new 9% debentures? 90 divided by 9% or 90 divided by 0.09, which is 1000. Your call, your way of presentation is your choice. I think this is easier to understand, so I've written that also. Yes, sir. Now it became a very straightforward question. You just need to pass the journal entry. What is the journal entry? 3 basic journal entries in amalgamation, which is what? Business purchase account debit to liquidator of well limited. How much is the PC, sir? 10,620. Check if they pass the entry. Yes. Then in second journal entry, what do? All the assets taken over at agreed value, you will debit. All the liabilities, or rather all the outside liabilities taken over at agreed value, you will debit. Balancing figure is either goodwill or capital reserve. If you get balancing figure on the debit side, it is goodwill. If you get balancing figure on the credit side, it is capital reserve. Right? So all the assets one by one we will take now. First asset, what you are able to see in the balance sheet, sir? You are able to see PPE. Was PPE taken over at higher value? Yes. How much? Or maybe we'll look at the adjustment only. Here. Where is it? Inventory was taken over at 10% more. What is the inventory value? 957. Anyway, we have written, we'll take off here. Okay, then this is mutual owing. We'll do it later. PPE was taken over at how much value? 19,656. So debited. Next, what did they give? Any other assets was there? No. Now come back to balance sheet. What other asset is there other than inventory and PPE? We have trade receivables. Any mention? No. That means taken over at what value? Book value. 19450 have they debited? Yes. Okay, then what, sir? Anything else is there? That's it. No. Cash and cash equivalent is not there. So all the assets is being captured. If you just check. Then all the liabilities. First liabilities is debenture. So debentures, how much did we taken over at? Though the selling company debenture was only 900, we gave new debentures worth how much? 1000. So that means the debenture are taken over at how much? 1000. Correct? Alright. Then any other liability? Bank has agreed to waive off the loan of 270. That means bank loan is taken over at what value? 4255. Yes, no? Correct? You want me to tell how I got the value again or okay? 4255. Okay, so this is 4255. Then anything else is there? No. Just go back to balance sheet. Any other liabilities there? We have a trade payable 4850. We have short term borrowings 1975. Any mention? No. In fact, they told also all other assets and liabilities are taken over at book value. So 4850 and 1975. 4850 and 1975. In this business purchase account, is it an actual account or dummy account? How do you cancel it? Here you have debited. To cancel here you will credit 10,620. Comfortable? Balancing figure is goodwill. That's it. Okay. Done. Then the settlement. Liquidator of well limited. What and all you gave the liquidator? Come back to your PC working note. You gave equity shares worth how much? Don't write 9,000. In this 9,000, 7,500 is towards face value of equity share capital and 1,500 is towards securities premium. So the journal entry will be liquidator of well limited account debit to equity share capital 7,500 to securities premium 1,500. Yes, sir. That's all you gave to liquidator or also preference shares? Preference shares how much? 1620. Can you write preference shares or preference share capital? If any new company issues preference shares, you have to show it as preference share capital 1620. Yes, sir. Now, other than this, some mutual owing, some other amalgamation expense entry you need to pass. Here, expense of liquidation. So, amalgamation expense is 55. So, which scenario is this? goodwill scenario. So what is the journal entry for amalgamation expense? Goodwill account debit to bank account. That's what they passed here. Okay, sir. All these are new now, repetitive adjustments. Then debtors of NICE includes 2,15,000 of well limited. For one company it's a debtor, for another company it's a creditor. So we have to cancel. Entry is creditors account debit to debtors account 250. Then here we have written debenture holders account. Instead of debenture holders, we used to pass like this. What is the debentures of selling company? 10%. So in fact we used to pass like this. So to 10% debentures, correct? Alright. Then we used to pass what entry? Instead of this 10% debentures is taken over at what value? 1000. Instead of 10% debentures, what did we give? 9% debentures. Old debentures you need to cancel and issue new debentures. So what is the entry for that? So entry will be 10% debentures account debit 1000 to 9% debentures account 1000. Like that we will pass. If you don't want to use 10% debentures, you can also use debenture holders. The choice is yours. I think in all our regular class we used to write 10% debentures. So we can pass like that also. Yes, sir, people. Keeping this only in mind, you prepare a balance sheet. That is very straightforward. I think I'll not go into that. That's a very straightforward one. Okay, sir. Alright. So that way also this question is pretty straightforward. Online has any issues? No. It's not necessary. Someone is saying, sir, if you route it through debentures, should I write 900? No. When we write 10% debentures, no, assets and liabilities we don't take over at book value. In this journal entry, will we take over assets and liability at book value or agreed value? Agreed value. Okay, book value is irrelevant. Alright, whatever is agreed value taken over, write that only. Fine. So since if you have taken it over at 1000, you write it at 1000. Fine. Okay, awesome. So moving along. Okay, one last question of this particular paper was that was the whole highlight of this particular paper, I would say. Okay, why is it highlight this? They combined AS21 and AS23 and framed a question. Consolidation of financial statement and consolidation of associate company. Both they combined, they gave one question and they asked the requirement. Okay, if you just check the requirement also, they did not ask like this. See what they asked? They asked you to prepare trade payable consolidated. In consolidated balance sheet, how much is trade payable? In consolidated balance sheet, how much is current assets? What is minority interest value? What is goodwill or capital reserve on cool car acquisition? What is goodwill or capital reserve on good car things? Then P&L consolidated, general reserve, revenue from operation, cost of material consumed. So it's a consolidation question only, but the way they asked the question was completely, the way they asked us to present the answer was slightly different. It was a 14 marker question. This will take some time. That's the reason few other questions, they gave it very straightforward, cash flow and all, because this will definitely take some time. Okay, I've solved this question fully in our format only. You remember consolidation we solve in a particular format. Same format, I've solved it so that it becomes easy for you to connect with. Just a minute. So let's run over this question. I'll read the question fully, then we will solve in the format that we normally use to solve AS21 question. AS23 ka just one working note it is. Okay, so nothing much on the AS23 to be honest. Okay, on February 2024, Best Limited acquired 80% equity shares of Cool Limited. So with 80% you get control. That means this Cool Limited became our subsidiary company. And 1st February is the date of acquisition, or we can call it as date of control, DOA or DOC. Okay, just check when is the balance sheet prepared, sir. 31st March 2024. When did you acquire the shares? 1st February 2024. That means February you acquired and March the year is ending. That means in the current year you got the control only for how many months? 2 months. Why am I stressing this? Because in subsidiary consolidation, you have to split between pre-acquisition profit and post-acquisition. Here, pre-acquisition period is 10 months. Post-acquisition period is 2 months. So that's a split up. On 31st March 2024, meaning on the year ending itself, Best Limited also acquired 25% equity shares in Good. With 25% you get control or SI. SI as in significant influence. That means the good company becomes our associate company. We have one associate also, we have one subsidiary also. And how much did we pay to acquire this? 3,80,000. Following are the balance sheet extracted in the books of Best Limited and Cool Limited and Good Limited. Both the three companies ka. The investor ka, the parent, subsidiary and associate. All the three company ka balance sheet they have given. Okay, balances they have given. Equity shares of 100 each. Great. Securities premium. Securities premium. Subsidiary company. Okay, I'll call this is the holding company. Cool Limited is the subsidiary company. Good is the associate company. Subsidiary company has some securities premium. Now, why am I marked or put a marker here? Because subsidiary company all the reserves in surplus we apportion between pre and post among holding company and minority interest. In this problem, we also have securities premium. All the reserves in surplus of subsidiary company has to be apportioned. So, including securities premium, you need to apportion. Do not forget that. Because in all the problems we have done so far, security premium was not there. We had general reserve, we had P&L, we had some revaluation reserve also maybe, but we never had a securities premium. Doesn't matter what reserve is it, every reserve should be allocated between pre and post. And that pre has to be allocated, further allocated among parent, holding company and minority interest. Post also has to be further allocated among holding company and minority interest. So that is one. 9% debentures we have, general reserve we have, and P&L balance is there. Okay. Investment they've given, fair enough. PP, current asset, trade payable. Okay, they've given balance. So this is not necessarily a balance sheet, just balances they've given. Trade payable includes bills payable. Then they give sales and other income. That means all these are P&L related information. And raw material consumed, wages and production expense. Okay. Additional information. P&L account of Cool Limited. Cool is what, sir? Subsidiary company. Showed a credit balance of 30,000 on 1st April. So 1st April 2023, our current year is ending on 31st March 2024. That means what is this? Opening balance of P&L of subsidiary company ka P&L opening balance was 30,000. What is the closing balance of P&L of subsidiary company? 2,70,000. Opening balance was 30, closing balance has become 270 means obviously P&L balance is increased. Why? Because you made some current year profit. There is no adjustment here, so directly I can write. So current year profit is 30 minus 270, which is 2,40,000. Okay, I'll also put up a normal format called ledger, but just quickly discussing. General reserve balance is brought forward from the previous year. How much is general reserve, sir? 84,000. So this 84,000 came in the current year or it came from last year? That means indirectly they're telling what? Opening balance was 84, closing balance is also 84. Opening balance and closing balance is same. Because you know when general reserve balances increase, if it increases, we assume that it has come from P&L. We have transferred some money from P&L to general reserve. Is that the case over here? No. This is what, sir? Previously only, in the last year only, you had a general reserve balance of 84,000. Same has been carried forward to the current year as 84,000. So opening balance of general reserve is 84 and closing balance of general reserve is also 84. That is what they are trying to say. Again, ledger, I shall put it up soon. On 31st March 2024, all the bills payable in Cool Limited balance sheet were acceptances in favor of Best. For Cool Limited, it is bills payable means for Best Limited, it is bill receivable. This only we call it as what? Mutual owings. But hang on. However, on that day, Best Limited held only 3 lakh of these acceptances in hand, the rest having endorsed in favor of creditor. We have seen this also. Alright. So entire bill receivable Best Limited is not having, because bill receivable you have three options, right? If you remember. What are the 3 options available with respect to bill receivable? 3 options in fact. We had discussed in class. What are the 3 options for bill receivable? One, you can hold that bill till maturity and later collect the amount, or you can get the bill discounted, or you can endorse the bill to creditor. So here this particular Best Limited, they have endorsed some portion of the bill to creditors. How much they are holding? Only 3 lakh. That means indirectly they are telling you what? Mutual owings is only to the extent of 3 lakh rupees. Okay, don't take the full amount, to take only 3 lakhs. This adjustment is there in our regular class also. This is not a new adjustment to us. Yes, sir, people? Okay, Best Limited. Best is whom? Best is whom? Holding company, right? First is the Best, right? First company is the Best holding company. Cool is subsidiary. Good is the associate company. Okay. Alright. Best Limited, that is a holding company, purchased goods costing how much? 5 lakh from Coal Limited on 1st June 2023 at a price of 6 lakh 50,000. Here date is also given, 1st June 2023. 1 second, hang on. When did Best Limited acquire the shares? 80% control, when did they get? 1st February. That means this particular, in fact, this only we call it as stock reserve transaction if you remember. Check here. Holding company purchased goods costing 5 lakh from Coal Limited on 1st June at a price of how much? 6 lakh 50,000. So the cost of the goods is 5 lakh, but the subsidiary company supplied the goods at 6 lakh 50,000. So because of this transaction, did subsidiary company make any profit? Yes. What is the total profit made by subsidiary company? 1 lakh 50,000. Total profit we call it as stock reserve? No. Now subsidiary company sold goods to holding company. Now who has this goods? Holding company, correct? No. Since this transaction happened at cost price or selling price? Selling price. I mean this stock will be shown at what price in the books? Selling price. I mean some profit element is included in this goods. That only we call it as what, sir? Stock reserve, which we need to eliminate. Yes, sir. Okay. Now total profit is 1,50,000. What are they saying? The entire goods remains unsold with Best. So 100% of the goods is still remaining. That means 100% of profit is stock reserve. How much is that profit? 1,50,000. So indirectly they're saying stock reserve is 1,50,000. Any problem? Okay, G. Alright. Now what will you do for the stock reserve? Tell me, sir. What will you do for the stock reserve? Who made this profit? Subsidiary company sold goods to holding here. So it is a upstream wala sale, not downstream. Downstream means holding company selling goods to subsidiary. Here it is upstream. We have discussed this. One question maybe I had done it also in our regular class. When subsidiary company makes, when sell the goods, subsidiary company has made this profit. So this is realized profit or unrealized profit? Unrealized profit. Unrealized profit can we show or eliminate? Eliminate. So subsidiary ka profit only we prepare working note number 4. What is working note number 4? Analysis of reserves and surplus of subsidiary company. There we need to eliminate this. Okay. Under pre or under post or because in working note number 4 subsidiary ka reserves and surplus we segregate between pre and post. Here this has to be pre. Why pre? Usually unrealized profit we show it under post. If you remember our notes also, I had given a notes that if subsidiary company makes any unrealized profit, reduce it from post acquisition profit is what I had dictated in the notes. But here it should come under pre. Can someone tell me why? Perfect. Sir, here the date on which you, holding company, when did they buy the shares? 1st February 2024. When did the sale of this goods happen? 1st June 2023. That means this has come in the post period or pre period? Pre-acquisition period, I mean the sale has happened. Not in the post-acquisition period, okay? If they don't give the date, generally as a convention, no logic, we show stock reserve under post-acquisition profit. If they don't give any data, here data is missing or given clearly. Given clearly. That means this comes under post-period or pre-period. Pre-period. Before acquisition only, the sale has happened. So that means we should put this under pre-acquisition period only. And why are we putting under pre-acquisition period? Because here subsidiary company has sold the goods to holding company. That is the reason we have to show this in working note number 4 under pre. If it was holding company making the sales to subsidiary company means, then we will put it under working note number 7, consolidated reserves and surplus or consolidated P&L. There, you will eliminate from holding company ka profit and loss. That wala problem also we have covered in our regular class. Yes, our people? I'll again solve, but just quickly discussing. That did not. See, if someone is saying you have to reduce from minority interest. Sir, if you reduce from working note number 4, right? Working note number 4 ka value only you distribute among whom? Parent company and minority interest. So if you have reduced from here means automatically that reduction has already happened. Once more you don't have to reduce. Okay. There are multiple ways to present. But once we show it under working note number 4, again we will not reduce. So don't compare it with ICA solution. Only final answer. Maybe if you've seen that and asking me, I don't know. Okay. But in our approach, no need to do that. Once you reduce from working note number 4, things will be automatically taken care of. Okay. Alright, next. Best Limited is preparing CFS for the year ending 31st March 2024. Great. You are required to calculate these things. So you don't have to prepare whole consolidated financial statement here. You need to prepare some portion of CFS you need to prepare. Meaning in consolidated balance sheet, how much will be trade payable? In consolidated balance sheet, how much is total current assets? How much is the total value of minority interest? What is goodwill or capital reserve on acquisition of Cool? Cool is what? Subsidiary. So that is your working note number 5 or working note number 6 is what we used to prepare. Then they also ask goodwill or capital reserve on acquisition of good. Good is our associate. Even when there is associate consolidation, we have to calculate goodwill or capital reserve. This is for what? Disclosure purpose. If you remember AS 23, correct? How do you get associate ka goodwill or capital reserve? Compare cost of investment with net assets, right? And accordingly, you will either get goodwill or capital reserve. P&L account consolidated. This is our working note number 8 or 7, which we used to prepare in a regular class. I don't know, 7 or not sure. Maybe 7 or maybe 8. Which one? 7. General reserve. Usually working note number 7, we prepare not just for P&L. We used to call it as consolidated reserves in surplus. So this gets covered under working note number 7 itself. Revenue from operations. So this is not consolidated balance sheet. They are asking consolidated P&L wala data. Cost of material consumed. Again, this is a consolidated P&L data. We'll talk about that. Forget about the requirements. What we will do is all our working notes, we will present it in our normal fashion. Then we will come back and see the requirement and solve it. Is it okay? Okay, let's re-jog our memory. What is the first working note? In fact, all consolidation question we solved in one format. What is that first format, sir? First is the shareholding percentage. First, in subsidiary company, how much control we have? 80%. We have a shareholding of 80%, means minority interest has how much? 20%. So we also will have associate. In associate company, how much shares we have? 25%. It is given to us in the question. I have just presented here. First, we will do all the working notes relating to subsidiary consolidation. Associate, it is just one working note or one calculation statement. That's all. So what is second working note we used to prepare in consolidation problem, sir? General reserve of subsidiary company. So how much is the general reserve? And they told in the question, subsidiary has how much general reserve? 84,000. What did they say for general reserve? General reserve balance is brought forward from the previous year. That means this 84,000 came in the current year or it came from last year. So opening balance of general reserve, indirectly they're telling us how much? 84. Closing balance is also 84. So any movement, anything transferred from P&L to general reserve? No. Opening and closing same. This working note done. Can I move on to the next? Yes, people? Okay, working note number 3 we used to prepare P&L account of subsidiary company. Check. Do you know opening balance of subsidiary company? Yes, they've given in the question. How much is that? 30,000. So you'll write it as buy balance brought down 30,000. Correct? Now go back to the balance sheet. Do you know P&L balance of subsidiary company? Yes. In balance sheet, how much is it given? 2,70,000. What is this 270? It is this is the balance as of which date? 31st March. So obviously this is what balance? Closing balance. So closing balance of P&L, where it will come? 2,70,000. Opening balance was 30, closing became 270. How from 30 it became 270? In the current year, you have earned a profit of 2,40,000, arrived as a balancing figure. This is what we used to do in our regular consolidation question. Yes or no, sir? Need a minute, I'll give you time later on. Is it okay? In the interest of time, some of them will be like, they will be watching on the last moment. I'll show the screen that time later on if you can update it. For now, can you just listen? Later, I'll give you time to update if you want. It's okay with you? So, working note number 3 is done. What is working note number 4? Analysis of reserves and surplus of the subsidiary company. Now, in this working note, what do we do? First, subsidiary company, all the reserves and surplus will be split between pre and post. And that pre and post will be further allocated among holding company and minority interest. In what ratio? In the shareholding percentage of 80 and 20. One by one we have to take. First, opening balance of general reserve. It came in the post acquisition period or it was there since last year? That means this 84,000 should come there under the pre-acquisition period. First of all, how much is pre-acquisition period? Our current year starts on 1st April 2023. When did we acquire the shares in subsidiary company? 1st February. That means can I say from April to 31st January? It was pre-period. Because you got the control only on 1st February. So February, March, 2 months is post. So the first 10 months is what? Pre-acquisition period. Done now? Alright. Opening balance of general reserve is how much? 84,000. This 84 split between the holding company and minority interest in 80-20 ratio. That's a split up. That is one. Next, opening balance of P&L. How much is that? 30,000. Thus 30,000 again. Opening balance of P&L means pre or post? Pre only. 30,000 split between holding company and minority interest in 80-20 ratio. Correct? Then we'll first do off working notes and then we'll go back to the adjustments. Now, current year profit is how much? 2,40,000. Entire 240 should come under pre, post or partial? Partial. Why? Sir, this profit of 2,40,000 is for 12 months. In the current year, out of 12 months, first 10 months is pre. Next 2 months is post. So we need to calculate how much is the total 12 months ka profit? 2,40,000. For 10 months, how much is the value, sir? 2,40,000 is a profit for 12 months. For 10 months, how much is it? 2 lakh rupees. Correct? That 2 lakh rupees is already there before parent holding company became shareholder. I mean, this 2 lakh should come under which category? Pre. Yes, no? So 2 lakh again split among holding and minority interest in this particular ratio. Easy. So all this we have got it from what? Our workings. Now go back. In fact, we ticked also. We also have subsidiary company also has some securities premium. Have they told the security premium came in the current year? No. So security premium will come when the company issues shares. Have they told shares are issued in the current year? No. That means what is the assumption? This was there from many years. We don't know. That means what? This security premium should come under post category or pre category? Pre category. Yes, no? Because it did not come in the post period. When it came, we don't know. They've definitely not told that shares have been issued in the current year. So the assumption, normal assumption is to take it in which period? Pre-acquisition period. So opening balance of security premium, take it as 2,20,000. Do remember that all the reserves in surplus should be allocated among pre and post. Not even one should be missed out. So 220 in 80-20 ratio, you split up, this is the value you will get. Done now. That's all. One more. Here, subsidiary company sold goods to the holding company and they made some unrealized profit. How much is unrealized profit? Here we wrote it also, no? 5 lakh worth of goods, they sold it for 6 lakh 50,000. How much is the total profit they made? 1,50,000. Is entire goods remaining unsold? Yes. I mean, stock reserve is how much? 1,50,000 ka 100%, which is 1,50,000. Who made this profit? Subsidiary company. Now, for as long as subsidiary, so legally subsidiary is a separate company, holding company is a separate company. Legally, subsidiary can sell the goods to holding or holding can pay the money to subsidiary. That's okay. But for consolidation purpose, are we treating subsidiary company, holding company as two different company or one? One. That means, can you show this profit in consolidated financial statement? No. If you show, then it looks like you made the profit from yourself. Hence, all this should be what? Eliminated. Okay. Who made this profit? Subsidiary company. And all the subsidiary ka profit only we are analyzing here. Hence, it will be considered over here. Done now. If holding company made the profit, means we will take it in the holding company ka P&L working note. Here, since subsidiary company made the profit, we will put it over here. And when was the sale made? Clearly they gave. The sale ka period was what? 1st June. You got control only on 1st February 2024. Before you got control, only sale was made. So this unrealized profit should come under pre or post? It should come under pre. How much is that unrealized profit? 1,50,000. So this 1,50,000 profit you need to eliminate. That means profit you need to reduce. Profit, if you have to reduce, means positive apportionment or negative apportionment. Because this profit, whatever you have, no, that you need to reduce. So hence 1,50,000 you have to reduce. Okay now? Alright. Now 1,50,000 you split between 80-20 ratio. So this will be the amount. Done, Asaru? Any problem? So by totaling, you will get holding company ka total share of pre-acquisition profit 307,200. Minority ka interest will be 76,800. You ask, minority interest will be not reduced. See, this is minority share of unrealized profit already gets eliminated. Again, elimination will not be necessary. Can I move forward? Similar way, we have to calculate what? Post-acquisition profit. What is the total current year profit? 2,40,000. In this 2,40,000, 10 months is pre-period. How much is post-acquisition period? 2 months. 2,40,000 is for 12 months. How much for 2 months? When you calculate, how much it will be? 40,000. This 40,000 again split between holding company and minority interest in 80-20 ratio. You will get post-acquisition share of holding company and minority interest. Comfortable? In this problem, if they want, they could have played a little more extra trickiness. I'll maybe just discuss that with you. So far, good. Suppose this unrealized profit ka date was not given. If this unrealized profit ka, if the date was not given, what you would have done? Can you tell me? You will put it under post, correct? If this unrealized profit ka date was not given, means you will put it under post. No logic, just a convention. But now you can't do that here. Why is, just check how much profit you need to eliminate. 1,50,000. But current year post acquisition profit is only 40. From 40 can you eliminate 150? No. That means that is also an indirect indication that the sale was not made in the post-acquisition period. It got made in the pre-acquisition period. Here anyway, date was given. Even if date was not given, still you have to put it under pre only. Because post-acquisition profit is only 40. And the sales you can eliminate 150. That looks a little odd. Is that okay? But anyway, here in this problem, dates is given. So that is not an issue. Just saying, just discussing. Okay, sir? Any problem? No. I'll give you just a minute. Just observe this. Components. The only new component here is the securities premium. Another one is unrealized profit made by subsidiary company when they sold the goods to holding company. You should put that under pre. That is the only takeaway of this particular question till here. Rest everything. In fact, if that AS23 if it was removed from the question now, I would have given this question as homework. Nothing is there other than this adjustment because everything is pretty straightforward. No pre-acquisition dividend, no bonus shares adjustment, nothing. Very, very, very straightforward consolidation question. So working note number 4 is done. So working note number 5 normally we put it up for minority interest. Here it's not working note, it's actually a requirement. Requirement number 3. Hence instead of working note, I've written it as point number 3. Now how do you get minority interest? Minority interest is the shareholder. Shareholder will ask for 3 things. One is here's the share of share capital, here's the share of pre, his or her share of post. So what is subsidiary company ka share capital? 20 lakh. Minority interest owns how much percentage shares in subsidiary company? 20%. So 2 lakh ka 20% is 4 lakh. Plus their share of pre and their share of post. Both comes through which working note? Working note number 4. Minority ka pre share is 76,800. Post share is 8,000. 76,800 plus 8,000 if you do. Totally minority interest will get it to be 4,84,800. That is your total minority interest. Comfortable? Can we go for the next? Next we used to calculate what, sir? Goodwill or capital reserve. That we used to put it as working note number 6. But here that's one of the requirement. Requirement number 4. So goodwill or capital reserve relating to what? Associate consolidation or subsidiary consolidation? This is relating to subsidiary. Tell me, sir, what is the format? Same one. First you take the cost of investment. Then reduce pre-acquisition profit. Then reduce pre-acquisition dividend if you have any. Then reduce face value of share capital. Correct? How much is cost of investment? They only told. Check. Best acquired 80% equity shares for how much? 14 lakh 80,000. Then what is holding company ka? Their share of pre-acquisition profit? 307,200. Reduce that. Pre-acquisition dividend, it's just a format I've written. In this problem it is not there. Then reduce what? Share capital. Total share capital or holding company share? What is subsidiary company ka share capital? 20 lakh. What is holding share? 80%. So it will be what? 16 lakh. Do this. Positive number means goodwill. Negative number means capital reserve. Here you are getting a negative number. So it becomes a capital reserve of 4,27,200. That's all. Tell me, sir. Anything different from, we have done almost 15 plus questions on consolidation. Anything is different here? No. Can I move on to the next? Okay. Next we used to usually put up P&L ka. But before that, let's do off the requirements. Next requirement is goodwill relating to associate company. Goodwill or capital reserve relating to the associate company. So this we have already calculated as per AS23. Same format. How do you get goodwill or capital reserve? Compare cost of investment with the net assets of associate company. Total net assets or our share? Investor share in associate company ka net assets you need to compare. Okay. So net asset denotes the net worth. If your cost of investment is greater than the net asset, then means the investor has purchased the shares by paying more. So meaning investor made a loss, which becomes goodwill. If however, if cost of investment, if it is lesser than share in net assets, then capital reserve. So that's what we need to find out. First, how much did the investor pay for this 25% shares? 3,80,000. So cost of investment is 3,80,000. Now compare this with what? Share in net assets of associate company. How do you calculate net assets? One approach is you can do assets minus liability, or another approach is shareholders funds. Both we have used. Correct? Shareholders funds means share capital plus reserves and surplus. Why do we take so much of assets and liability? Directly we'll use this. No, this is straightforward. What is associate company ka share capital? 10 lakh. Take your calculator. What in all reserves they have? They have general reserve of 1,20,000, P&L of 50,000. Sir, this is the closing balance, sir. Yeah. We have to calculate the share of net assets on the day you got significant influence. Ironically here, you got significant influence on which date? on 31st March. And all these are balances on which date? 31st March only. Okay now. So in this problem, the balance sheet information and the date you got significant influence are same. Otherwise, when you have to calculate net assets, you have to calculate net assets on the day you got SI. Here SI ka date and year ending date are same. So we can take the value here only. Okay sir. So take share capital is 10 lakh, general reserve is 120, P&L is 50. Add everything. Those take 11 lakh. 70,000. So 11 lakh 70,000 is a total net assets of associate company. Will we get share in total net assets or our share? What is investor share? 25%. So calculate that. 2,92,500. So that's what I've listed over here. Equity share capital, general reserve, P&L. If you add, you will get total net assets. And investor ka share is 25%. So this becomes this. So the worth of our investment is how much? 292,500. But how much did we investor pay? 380. Worth is 292,500, but investor paid 3,80,000. So that means investor paid extra. So that means if he has paid extra means profit or loss. Loss only we call it as what? Goodwill. So goodwill related to associate consolidation is 87,900. Bacha problem. All this we have done in AS23. Many questions. Yes or no, sir? That is a requirement. Done now. Now one by one other requirements can we look into it? Then they asked the trade payable consolidated. Trade payable consolidated means, oh 1 second, online also till here good? All the working notes? Easy, manageable? Yes, okay. So trade payable consolidated is the next requirement. Trade payable consolidated means in your consolidated balance sheet, you will show trade payable. No? How much value you will show is what you need to ask. Now, common sense. Will you take all the 3 company ka trade payables and add off? Because they ask consolidated. So we have 3 company ka trade payable. Add it off everything? No. In associate consolidation, will we take associate ka assets and liability? No. Because we have studied this. When you do consolidation between holding and subsidiary company, investment in subsidiary company will not come. But rather subsidiary ka assets and liabilities will be added 100%. Yes sir. But when you do consolidation with associate company ka assets and liability we will not show, but rather what will come? Investment in associate will come, that too as per equity method. So here all the associate company ka data you ignore. Only holding company ka and subsidiary company ka assets and liability you need to add. Did they ask you balance sheet or consolidated trade payable? Trade payable. So only add these two. Yes sir. Comfortable? If there is any mutual owings, reduce. Do we have any mutual owings here? Yes. There was a mutual owings to the extent of how much? 3 lakh. Take a calculator. Add these two. 380 plus 410. 7 lakh 90,000. Minus mutual owings how much? 3 lakh. Reduce. And this 4 lakh 90,000 is the value of trade payable that will come in consolidated balance sheet. Easy. Can I move on to the next? Next they ask current assets in consolidated financial statement. Tell me sir, what and all will come? Will current assets of holding company come? Yes. Will current assets of subsidiary company come? Yes. Current assets of associate company? No. But if there is any mutual owings, reduce. If there is any stock reserve, because it is current assets. Current assets will include debtors also, inventory also. What do you do for stock reserve? You reduce it from inventory. So 4 components. What is the current assets? 965 and 560. Add. 965 and 560. Add it up. Yes. Minus what sir? Mutual owings you reduce from trade payable. You also have to reduce from trade receivables. Trade receivable is part of current assets. So how much is mutual owings? 3 lakh. Minus how much is stock reserve to be reduced from inventory? 1 lakh 50. If you reduce, you will get total current assets that will come in consolidated balance sheet, which is 10 lakh 75,000. Any problem? This is second requirement. All these are pretty straightforward. In fact, for this and all, no, you don't even have to read the question. They asked how many requirements in the question? 9 requirements and 14 marker. Maybe this requirement and all carries only 1 mark. So if you don't have time, at least you could have solved these 2. Minority interest you could have solved. Right now that working out. So even in some questions which doesn't make sense to you also, at least 4 or 5 marks easily you can capture. Even if you don't understand it fully. If you just, you'll have to just keep your open mind here. Okay. Because the entire question will not be new. There will be some 4 or 5 adjustments in a particular question that could be newly framed. But rest everything will be straightforward. So it's still easy to score 4 to 5 marks. So don't give up the question completely. Read it and aram se. Don't freak out when you see this attempt. I'm pretty sure the moment the students saw this and the moment they saw this, 3 companies. They are used to seeing how many companies? 2. The moment they saw 3, full gada gada gada. But the reality is you may not get 14 on 14, but simply if you had kept your cool and kept your common sense, still you could have picked up 6 to 8 marks from this question easily. Within 25 to 30 minutes that too. Because this working note, all whatever I've done over here, okay, this particular working notes from here to here, anything new or same? Same. At least you could have done that much and cleared off, no? Right? Okay, so that's the point is that. Right, coming back, what else they asked next? They asked P&L consolidated. This only we used to present it as working note number 7. Tell me, sir, how? And they only asked P&L consolidated. Usually in our working note number 7, we show consolidated reserves in surplus, meaning P&L and all the reserves put together. But they have asked only P&L. So how do you take this? Take P&L of the holding company. How much is P&L of the holding company? 3,26,000. That is one. Next what, sir? Add post-acquisition profit from subsidiary company. That is there in our working note number 4. What is holding company ka share of post-acquisition profit? 32,000. Add it. Then post-acquisition profit of associate company. 0. Why? We bought associate company ka significant influence only at the end of the year. That means every profit we have is only what? Pre only, correct? No. Because we acquired the associate company shares on the last day. So pre-acquisition profit is 12 months. Post-acquisition profit is 0. Adding all this, you will get the total consolidated P&L, which is 3,58,000. Easy. Any doubt? General reserve consolidated is the next requirement. Meaning, in your consolidated balance sheet, what will you show as a general reserve? Pretty common sense. Sir, will you show general reserve of subsidiary company? Will subsidiary company ka share capital and reserves in surplus come in consolidated balance sheet or already a portion? Already a portion. Will associate company ka any data come in consolidated balance sheet? I mean, this also what? Cut. What will come as general reserve in consolidated balance sheet? Holding company ka share, which is how much? 2,69,000. This was given as a question only. 1 mark straight away, swaha. Okay, so that means this requirement ka answer is what? General reserve that will come in consolidated balance sheet is 269. That's relating only to what? Holding company. Correct? Any problem? Alright. Now, next is revenue. This is one important question. Revenue in consolidated financial statement they're asking. So, revenue means sales. Sales, will you show it in balance sheet? No. This, when they say consolidated, they are talking about what? Consolidated P&L account. Okay? Now, what do you normally do? Associate company ka any data will you take or ignore? Ignore, because associate company ka assets, liability, income and expense we don't show. We only show what? Investments. So leave that. Subsidiary company ka what do you do? 100%. So take holding company ka sales and subsidiary company ka sales. How much is that? 56 plus 38. How much is that? 95 lakh. This you should not do. This you should not do. Take 56 lakh as it is. Take your calculator. 38 lakh into 2 by 12 you do. 38 lakh rupees into 2 divided by 12. How much are you getting? 38 lakh at 2 by 12 if you do, you will get 6 lakh 33,333. This you should take. Why, sir? Sir, balance sheet consolidation is as on a particular date. Whatever value you have on that date, entire value you take. But P&L you don't prepare as on date. In fact, P&L ka heading is what? P&L is for a particular period. It's for the year ending. So, did you get the control in subsidiary company for entire 12 months or only 2 months in current year? We bought subsidiary ka shares on 1st February and year is ending on 31st March. So, from 1st February till 31st March, if you count, how many months is that? 2 months. So, whenever you're doing, keep this in mind. This question used to be there about 5-6 years before. I used to see consolidation P&L questions like this. In the recent past they've removed that. Again, they introduced. Next, in your attempt, you may get consolidated P&L question, where they may tell, we got control only in the current year for 2 months. That means don't take subsidiary ka 100% of income and expenses. Take only for 2 months. Every income, every expense you have to multiply by 2 by 12. Why 2 by 12? In the current year, you got control only for 2 months. If you had got the control for 3 months, means 3 by 12. Like that. Okay, subsidiary consolidation is always for the period. If you have control for the whole year, then you will do 12 by 12. Since in this problem, you got the control only for 2 months in the current year, you have to take only 2 months income of subsidiary company as well as 2 months expense of subsidiary company. Entire expense, entire income should only be considered for 2 months. Understanding this? This sort of questions we don't have in the study material currently, but now it has come So you might get a consolidated P&L question in your attempt like this. That's the reason I'm saying. Okay, simple. Holding company ka take full data. Subsidiary company ka prorate by 2 by 12. Every income, every expense by 2 by 12. Every problem 2 by 12? No. In this problem, we have control over only for 2 months. Hence 2 by 12. If you have control over 7 months means you will do 7 by 12 like that. This is only for what? P&L consolidation, not for balance sheet. Can you keep this in mind? So adding, that's the reason 38 lakh into 2 by 12 if you do, you'll get 6.33 lakh. So total revenue that will come in consolidated P&L is 62 lakh 33 333. This is a new point. I hope online also is clear with this. Can you quickly confirm on this, people? Okay, great. Next requirement they asked is cost of material consumed. Now, will you take cost of material consumed for associate company? No. Will you take it for holding company? Yes. Subsidiary company, will you take full? Will you take full or 2 by 12? So take 36 lakh 50,000 full and 31 lakh 20,000 ka 2 by 12. That's what I've done over here. Holding company ka full data, subsidiary company ka only 2 by 12 portion, which will be 5 lakh 20,000. This is the value of cost of material consumed that will come in your consolidated P&L account. Done? That's all is this question all about. Good question in a way for a couple of adjustments. One, they asked, if I have to summarize this question once, one, they gave securities premium, which was not available in any of the previous question. That is one takeaway. And the second one is you got the significant influence only on the last day. Keep that in mind. Third one is here, who had sold the goods to whom? Subsidiary company had sold the goods to holding company. So who made the profit? Subsidiary company. This is realized or unrealized profit? Unrealized profit, which we need to eliminate. Usually, where will we eliminate this unrealized profit? Under post. But here sales was done in the post period or pre-period? Pre-period. That means we have to reduce this unrealized profit or stock reserve from which period? Pre-acquisition period. That is one. Okay, it's another takeaway. Rest everything pretty much the straightforward way. Okay, and also probably the P&L consolidation, you should not take full value, you should always prorate. If you have control for 2 months means all income and expenditure you have to do 2 by 12 in consolidated P&L. In balance sheet, we don't do this because balance sheet is an as on a point consolidation. P&L is as for the period consolidation. That's the reason. Done up. That's it with respect to this question. Yes, all the other question. Yeah, we've done all the other part. The sixth question is repetitive. Okay, so there's no change. Sixth, A and B both are repetitive. B, C. Everything is also a repetitive question. So there is nothing new from, yeah, that's it, sir. So from this paper, this is all that we could newly learn from this particular question. Thank you for your patience. Take care.